Hello, everybody. Welcome to the Canis Major Deal blog. I'm Phil Grove. Each week we do a video blog of a commercial multifamily investing lesson, opportunity, or deal in the state of Texas. And this particular week's video is part of a three-part series with part two on deal underwriting being presented today by David Teo. David, are you on the line?
Yes, I am.
Well, take it away, buddy.
Hey, thanks, Phil. Hello, everyone. My name is David Teo. As Phil mentioned, today I will be sharing with everyone part two of a three-part series on deal evaluation. Before I go into the presentation, a quick introduction of myself. I'm based in Austin, Texas. I graduated from the University of Texas at Austin with a degree in computer science. I spent 12 years in the tech industry, initially in technology consulting, and move on to strategy and product marketing shortly after. In 2014, I transitioned into real estate full-time and started working with Phil and Shnoa. Primary focus from that point was in infill development in Austin, where I buy tear-down lots and build condos on them. And I quickly, diversify into a commercial investing. Currently investing in invested in several hundred doors in the state of Texas. Since the March of 2017, I have been working with Canis Major Incubation as an acquisition specialist. And so with that, let's have a little recap, right? So as I mentioned, this is a three-part series. Part one was presented by my colleague, John Leidecker, and he touched on things like a quick analysis to determine if a property is viable, and then once it is, the on-site visits, what to look out for, what questions to ask, and the data that needs to be collected right during those visits. Part two, which is what I'm focusing on today, is on once we have all this data, right, we take this data and we use it to develop a 5-year pro forma. So this is the underwriting portion of the process where we go deep into the analysis to determine if this, if the deal at its current asking price, it's attractive, right, for our investors and for the management. Then, if it is, then we, make an offer and get it under contract. And once we get through the contract process, then we move on to the next part, the final part, part three of the process, which is carrying out the physical due diligence. And next week, another colleague of mine will go into that in more detail, and he will also go into detail the closing process to get the acquisition process completed. So that is a quick summary of the three-part series. Now, just a quick reminder, right? From part one, we had talked about the process of visiting the subject property and comps, right? And the objective of which was to collect, a set of data that we could use to build the pro forma, right? So we go on these site visits. We collect information that allows us to identify, additional revenue sources to allow us to estimate what the operating expenses are going to be, the capital improvement, costs, the repositioning, of each unit, right? How much is it going to cost? And then, the visit to the comps, allows us to understand to what level of upgrades we need to make for each of these units, which then allow us to determine what the cost would be to upgrade the units of the subject property. And in addition to that, we will also be collecting, market rent information, right? When we go visit this comps, it allows us to understand, okay, for the repositioned properties or the remodeled properties, what are they charging for that? So that allows us to establish the market rate for rent for the like type properties. So, next let's take a look at what a pro forma looks like, right, from the perspective of the format of it. So the pro forma, as you can see, typically the pro forma runs for a project runs for 5 years, but sometimes it can be longer than that, and sometimes shorter. But most typically, it's around 5 years, and pro forma are usually built for a 5-year period. So the first section that we're focusing our attention on is the income section, right? What you see here in this orange box. So in the gross potential rent, that's essentially the market rent, right? The loss to lease, that's the difference between the market rent and the actual rent that you can get your units to rent for. Right? Vacancy loss is basically the charges allocated to vacant units in the property. So the effective gross income is essentially the gross potential rent plus other income, minus loss to lease, minus vacancy loss, minus concessions. Okay. So next section that we're looking at is the expenses. So we have things like property tax, payroll, contract services, management fees. So payroll essentially it's the payroll, the salary for the property manager and for the maintenance crew. Management fees are fees paid to the management company, for managing the property. So this is, in essence, a percentage of the effective gross income, typically between 4 to 6%, depending on the number of units. The last section here is the return section, as I call it. It has two very important set of numbers. The net operating income is incredibly important because that's the number that determines the value of your property. And the operating cash flow, ultimately what that is at the end of the day, what is the money left at the end of the year that would go into the pocket of the investors and the management and the sponsor, right? So that's is a quick overview of the format of the pro forma. Now, to be able to fill out the pro forma, there are a few things that we need to understand and know before we can actually go ahead and fill out a pro forma, right? So there are several important variables that we need to know how to estimate. The first being the revenue potential. How much rent can we increase after repositioning each unit? What are some of the additional revenue sources that the subject property could actually make, right? And then operating expenses, right? We need to be able to determine the number of maintenance personnel required, and that's dependent on the number of units, the amount of deferred maintenance, and things like that. A lot of this expenses type information we can get from National Apartment Association. So the NAA publishes on an annual basis an income and expense survey for different regions. So that can be a source of information as an estimate of the operating expenses for the subject property. But the best type of information would still be from previous deals, right? If you have, previous similar deals that you can draw some data from, to plug into the pro forma, that will be much better because that's directly, from your own experience and from your own set of data, as opposed to a set of averages across a bunch of properties that you're not quite familiar with. So more experienced sponsors with a varied set of portfolio would have a richer set of data to draw from to be more accurate in the expense estimation, right? So for new investors, it's always good to partner up with more senior, more experienced sponsors. So the revenue, and the OPEX, and the revenue potential and operating expenses, estimation allows you then to understand, the cash flow, right? At the end of the year, what will be the projected cash flow on a year-to-year basis? Now, at the end of the 5 years, when the property gets sold, to be able to project what the sales profit would be, by selling the property, we need to be able to estimate what the repositioning cost would be, like remodeling costs is another word for remodeling, and also the capital improvement cost of replacing roofs, siding, and things like that. So these are important variables that we need to be able to estimate to a good degree of accuracy. All right, so now we talk about estimating these values, right? To be able to fill out the pro forma from year one all the way to year five, right? We also need to understand what are some of the typical value add strategies, right? And the way we can look at this is by kind of categorizing them in two broad categories, right? If the property is at least 90% occupied, or if the property is less than 90% occupied. So if the property is at least 90% occupied, the focus is more on increasing rent. That's the higher priority than increasing occupancy because the occupancy is already at least 90%. So then the focus is more on the exterior repairs, right? Especially those that has a positive aesthetic effect on the property. So you want to beautify the exterior, draw in prospective tenant traffic, which then directly leads to rent increase. And you would do the interior repositioning as the units become available from lease expiration, and as the remodeling gets done for each unit, then you raise rent for those units. Now, if a property is less than 90% occupied, you kind of reverse the sequence. The objective or the focus or the priority is to increase the occupancy, right? So now you would have a crew that would be able to handle, remodeling a set number of units, right? So now, if you have way more vacant units than your crew can handle at any point in time, don't let those units sit empty waiting for the crew to be ready to fix them. Get them rented out to generate income in the meantime and increase your occupancy. So, what you need to do then is to reduce your rent to slightly under market for those that are left over, so to speak, and get them rented out, right? Increase your occupancy and bring in additional revenue at the same time. And then, as the first batch gets completed, we raise rents on those, and then you move on to the next set of properties where the lease has expired, and you then move on to reposition those. And while you're doing your interior, again, if there are critical exterior repairs that need to be done, don't wait, right? Especially like things like if you have a leaky roof, get it done right away. So as you're carrying out your interior repositioning, you can also simultaneously carrying out your quote unquote beautifying repairs, right? If you have poor looking siding, get that fixed, get that repainted, draw in prospective tenant traffic to result in a higher pool of competition for available units and to drive rent increase. So why is all this relevant, right? Why is it relevant to understand this strategy? Well, it is relevant because, as I pointed out earlier, if you want to be able to fill out the pro forma, build it from year one to year five, you need to understand some of these strategies so that you can understand year one what you're going to do, year two what you're going to do, and so on, right? So you need to be able to estimate the amount of time for the exterior repairs and the interior repairs, and when is the rent increase going to happen, and how quickly, right? And when stabilization occurs, right? So it's relevant because we need that to build a pro forma. So some common assumptions made, right? So in year one, what do we do in year one, right? So if a property is it falls under those two categories that I spoke about earlier again. So in year one, right, if the occupancy is above 90%, then we'll carry out exterior repairs and upgrade right away, and we will carry out some interior remodels for the ones that are available. And so for a scenario like that, then the concession will be rather low, right? Because the focus is in generating higher income, higher rent, and not to increase occupancy. So the concession will be lower. So when you scenario play like this, you would then understand how that affects the individual numbers in the pro forma. So you do the same thing for year one, year two, year three, year four, year five, and you have then a set of actions like this when you see on the screen, which would have direct impacts on the numbers that you see in the pro forma. So let's very quickly go over an example, right? So this is a real life example of an apartment complex. So let's focus on let's zoom into the income section. So the income section, what I get, let me point out a few things, right? Instead of going through the whole thing. So as you can see, we have the assumption section here where we have, between year 1 and year 2, year 2, year 3, and so on, right? Now, some things that may jump up to some of you watching this will be, oh, wow, loss to lease, year 1 to year 2, there's a big drop here of 38%. What's going on there, right? So a little bit of background about this property. This property is over 90% occupied, right? So the objective here is not necessarily to increase occupancy, but it is to increase income, right? Increase the rent. And in addition to that, this property was purchased where the original rent was quite a bit under market. So the new management was more aggressive in marketing it, and also because it's over 90% occupied, there was focus on the exterior and getting it, beautifying it and drawing in more traffic. There was more competition, and so it drives up the rent that is actually being rented out for, right? So the difference between the market rent and the rent that it actually gets rented out for shrank. So you have this dramatic decrease in loss to lease. And one other thing that might jump up to you is year 1 to year 2, there's a huge increase in the concession. And the reason is if you look back here, wow, in year 1 there's a huge drop in concession. They almost pretty much just shut off concessions totally. So again, this goes back to that strategy of, okay, it's over 90%. It's very, very highly occupied, and so the focus here is to increase revenue. So so concession was pretty much stopped at the point in time. And then year 2 and 3 and 4 and 5, you see that it kind of goes up to that level, and that level is essentially based upon the some tools that we use. CoStar is one of those tools. You can find the average concessions that properties comps in the area are giving. So so that's the number that we use to plug in for those years. Okay, so next let's take a look at expenses, right? So expenses, same thing here. We follow the same process. We establish the year 1 number. And I mentioned, the NAA survey can be a source of information, or from previous deals, you can draw data from that. And then, you make assumptions on the year-to-year growth, right? In this case, 3% across the board. That's based upon, historical performance of the area, of the property, of comps in the area, and also based upon tools like CoStar, for example, right, which gives us some trend analysis that would let us, forecast a little bit into the future. And just to point out, one number might jump up is this negative 19%. So for this particular property, it was known at the point of purchase that there was plumbing issues, that there's leakage. And so the expectation is once the leakage is fixed, there will be substantial cost savings in the water bill, right? So that's reflected in this number. So the final section here, which is the return section, right? For this particular deal, the sponsor was able to get the loan at a 3-year interest-only loan. So, for the debt service, you see that, from year 1 to year 3, it's interest-only, and year 3 to year 5, principal and interest. So plugging all that in, it gives you the cash flow for each year, right? Every year, you have a number, and this is the money that's left that could be distributed to the investors. Okay. Now, now that we've seen the cash flow, right? The the next thing we see is, well, at the end of the 5 years when we sell the property, right, what would be the profit from the sale of this property? So, we have, the purchase price, which is at 7.76 million. And the value of the property is determined at 10.9 million, right? And here, is the formula that is used to calculate the value. The NOI, the net operating income, as from the previous slide, we see year 5, net operating income is 819,000, right? So divide by 7.5% cap rate. Now that 7.5% cap rate, is a projection, right? It's based on historical performance and also future, forecasts of future performance based on what we know of the city, right, or the area that's in, whether the city, government, the local government is doing anything to spur growth and the demographical shifting and things like that. So that allows us to carry out some sort of forecast in terms of the cap rate. We arrive at a $10.9 million value, right? And in taking into account the closing costs and loan payoff and paying off the investors' capital, we got a gain of 1.75 million. So you add this number 1.75 million with the cash flow for each year. That's the total return, right? That this deal returns to the investor. So the question then is, you got to determine if this return is attractive enough for your investors and for yourself, right? If it is, then you move on to the next step, which is submit a letter of intent, LOI, to the seller, right? So the letter of intent is where you make your offer, and if it gets accepted, fantastic. You move on to the next step. If it doesn't get accepted, you go back to the drawing board and negotiate, right? So if it gets accepted, and the next step would be to execute a sales contract, a purchase and sales contract. And for commercial deals, they're usually provided by the seller. Seller either gets it drafted from scratch by an attorney, or the broker representing the seller has their own contract that they use. Or in the state of Texas, the Texas Association of Realtor does have a standard improved and unimproved commercial contract that can be used. So once the contract is signed, accepted and signed by all parties, the next step of the process is the physical due diligence, right? Where people go in and look at each and every single unit, and rent verification and financial verification, looking through all the books. This will be covered in detail in part 3 of this series. Another one, my colleague will be covering that next week. So with that, I would like to mention that as we can see, the deal underwriting process is fairly complex and requires quite a bit of understanding of strategies in value add and also experience to build an accurate model. The thing is, the entire deals kind of rest upon the shoulder of the performer being accurate, right? Because if the performer is too optimistic, then the risk of the deal failing increases substantially. So, I would always encourage new investors to partner up with more senior or investors or sponsors with more experience, with a more varied portfolio, in order to get the underwriting process done correctly and accurately, so that we get a good foundation on which the deal can stand on. With that, I think that's all I have for everybody today. Phil, do you have anything for me?
Yes, let me just go ahead and unmute myself. So thank you so much for David for going through all of that. Pretty awesome overview. Next week, we're going to do part 3 of underwriting. And David, can you give us a quick preview of what we have in the 3rd section of this 3-part series?
Yeah, absolutely. So in the 3rd part of this series, our colleague will be going through the details of the physical due diligence. So this is, he will go into the process of what to look out for, the type of checklist we use and things like that. Going into every single unit to check for different things. And then, lease verification, right? Comparing the leases with the rent rolls and things like that, and checking into the books. And also, he will go through the closing process. Once the due diligence has been completed, and everything looks good, then what will be the process, to carry it out to closing for the acquisition process to be finished. All right, Phil? Oh, seems like we might have a little bit of audio problem from Phil.
All right. Well, thank you so much. Yeah, David, losing my audio here. Yeah, I'm on a lease connection, but thank you so much. Guys, tune in for next week's video, and that concludes this week, and we'll see you on the next video. Thank you.
Fantastic. Thank you, Phil.